stocks of housing finance companies nosedived in the recent market-wide sell-off. However, the price performance of various HFCs has been divergent, resulting in stark variation in valuation. For instance, LIC Housing Finance, which is the second largest HFC, it's trading below FY22 order book value. On the other hand, a much smaller HFC like Home First Finance is being valued at 3.1 times book value estimated for FY24. What explains this valuation differential? A multitude of factors, the most prominent being market segment or sub-segment in which Home First operates and strong earnings. Incorporated in 2010, Home First is a tech-driven HFC that operates in the affordable segment, targeting first-time home buyers in low and middle-income groups. Affordable housing, essentially with a loan ticket size of up to 15 lakh rupees, is the fastest-growing section and is set to become a large sub-segment for HFCs over the next few years. Rising urbanization, increasing nuclearization of families and improving affordability are converting latent demand for affordable houses into a commercially lucrative business opportunity for HFCs. More importantly, several government schemes, the likes of interest subvention scheme, tax incentives, housing for all by 2022, infra status accorded to affordable housing segment, PMAY, along with regulatory push, will support high growth in the segment. While there are ample growth opportunities, affordable housing finance has become overcrowded with many new players. Also, banks have turned aggressive in the smaller ticket home loan market, but their lending to the economically weak section and low-income group without any formal income proofs is limited. While affordable HFC's growth moderated to 15% and 13% in FY20 and FY21 respectively, from a CAGR of around 40% between FY17 to 19, it remains higher than that of traditional players. As per CRISIL, affordable housing finance companies are projected to clock 15 to 20% CAGR through FY22 and 23, far outpacing the sectoral average. Home First has grown its book at a 30% CAGR in the last 3 years, successfully weathering the COVID wave. Its AUM stood at 5,380 crores as of March end. The company is well positioned to scale up its AUM in the medium term on the back of its strong capitalization and the ability to mobilize funds through diverse sources. Management has guided 30% growth in AUM in FY23. Home First's average ticket size is around 10.5 lakh rupees and portfolio mix is favourable, with home loans constituting around 91% AUM, loan against property at 7% and the share of relatively risky developer finance only at 1% of the AUM as of March end. It also enjoys a well-balanced customer mix, with salaried borrowers forming 72% and self-employed customers contributing 27% of AUM as of 31st March. It has widened its geographical reach and deepened its presence in the existing markets. Consequently, its relatively high geographical concentration in Gujarat and in Maharashtra has reduced from 69% in FY19 to 52% of the loan assets as of FY22. Home First's non-performing assets ratio has increased to 2.3% in FY22 from 1.8% a year ago, but it's mainly attributable to RBI's November 2021 clarification on recognition and calculation of NPAs rather than any real markdown in asset quality. The company's restructured assets stood at 0.65% of the overall book. PCR has also declined to 47% because of the RBI circular. The 90-day past due number came down by about 30 basis points in the fourth quarter, and the trend is likely to continue. Accordingly, the management expects credit costs to decline to pre-pandemic levels of around 30 to 50 basis points in FY23. Despite the high growth, Home First has been able to maintain superior profitability with ROA of 3.9% in FY22, mainly supported by healthy net interest margins and low credit cost. Going forward, we don't see much risk to margins as increasing cost of funds will be passed on. While operating expenses to assets ratio will inch up to 3 to 3.2% range, the same will be partially offset by lower credit costs. Home First has excess capital, due to which ROE is depressed. We expect leverage to improve in medium to long term, thereby improving the ROE as well. Affordable housing financing business requires deep feet on street and considerably evolved risk assessment processes, stringent underwriting norms, agile monitoring and superior collection mechanisms. With the use of technology and analytics, Home First has succeeded in creating all of these and built a superior franchise with significant competitive advantage. At the current market price, Home First is trading at 3.1 times FY24 estimated book value. For an HFC with a strong earnings growth potential and ability to generate ROA above 3.5%, valuations seem quite reasonable. On a relative basis, valuations look undemanding if we compare it to its peer Aavas Financiers, which is also into the affordable housing space and has delivered similar growth over the years and trades at a valuation of 4.1 times its FY24 book value. In the near term, we see earnings growth drive stock performance. In the long run, we see valuations getting re-rated, leading to a sizable upside in the stock price. Investors can therefore consider adding the stock in a staggered manner.